Yeah, so thanks for joining me this morning, Brandon Banlow from Banlow Consulting, Freight Brokerage Mastery. Today we're going to be talking about cash flow management. I think this is an important subject to cover when we're talking about whether it's starting up your business or even if you have a current business that you're operating right now. Cash flow management is something that everybody talks about, but I think it's overlooked, and I don't think enough time gets spent on talking about cash flow management because it really affects the health of your business. And so when we're talking about cash flow management, it's important to understand what that is and how it affects your business. And so the best thing to do is, you define it first. And so cash flow management is simply the process of tracking and controlling your business cash flow inflows and outflows. So everything that's coming in and everything that's going out, and to cover your expenses and to fund your growth. It's an important part of your business. And when you're really looking at your business, you want to look at it as a living entity. I kind of always refer to my business as my child, and I think a lot of business owners do. It is your child. You're always taking care of it. You're nurturing it. You're helping it grow and develop. And so if you're looking at it like that, then you have to take into consideration the health of your business. And the health of your business is directly impacted by your cash flow management. And so that's what we're going to be going over today is looking at cash flow management, what that entails, and some things to be cautious of, and some things to take into consideration when you're considering your cash flow management. Whether you're starting your business or whether you have a business up and running, I think forecasting is really where you need to start. If you're not forecasting your cash flow, you're going to get in trouble at some point. Forecasting is challenging because you really got to take a deep dive into your business. And this is looking at, the next 60 to 90 days to account for any cash that you need. And that could entail a lot of things. So you really got to sit down and you got to brainstorm. All right, where am I at right now? What am I putting out right now as far as expenses going out? And then what is coming in? And then what is left over? And then you look at that and you say, okay, so in the next 60 days, what do I think is going to happen, or where do I see expenses coming in? And that could be through a number of things, any cash receipts going out, expenditures going out. If you want to make some growth in there by hiring, or maybe you're getting a new office, maybe you need some new furniture, some new computers, new tech, whatever the case may be, you're making some changes in your business. Forecasting is really where you need to start when you're talking about cash flow management, whether it's a brand new business or a business that's currently up and running and you've been doing it for a couple of years, you're factorable after a year, whatever the case may be. But forecasting is big. If you're just starting your business, the forecasting is going to be, what do I need to make it through the first 60 days? And that's completely different than if your business is up and running and you're factorable and you got good credit. Because when you're starting out, you have no credit. So now you really got to be cash flow heavy, and you got to be tight with your expenses, and you got to track every dollar coming in and every dollar going out to make sure that you can cover payables, payroll, taxes, your IT stuff. All of that comes into play versus when you have your business established. Obviously, you're running on a net 30. Hopefully you're running on a net 30. We're going to talk a little bit about that in here, but hopefully you're running on a net 30, which means you're getting paid 30 days after you invoice your clients. So a little bit different on both spectrums, but forecasting is definitely where you need to look at. Never underestimate what's going out. I would always overestimate when you're forecasting. If you overestimate what you're going to need, you're going to be in a much better position than underestimating, because if you underestimate, obviously you didn't take into account some of the things that you thought you were going to need. And now all of a sudden it's a big shock to you and you say, oh man, I'm not even close to being in budget. So forecasting is definitely where you need to start.
Yeah, and so especially right now with how the market is, rates are low. Like, what are some strategies that you think broker owners should use to optimize their cash flow, so that they're still profitable, but they're also saving some money for when if the downturn takes a little bit longer than it is expected.
Yep. That's a great question. I think when you're looking at, putting cash into reserves and stuff like that, and making sure you're healthy going forward with your cash flow management, especially in, the state that the industry's in right now, as you said, Rates are extremely low. They've been historically low since the turn in 2021 going into 2022. Obviously, the rates were considerably better for everybody out there at that time. On the transportation side, they weren't so great for the buyers and sellers of goods at that time because the expenses were quite a bit higher on their side. Um, so when you're looking at it, if you want to make sure that you're in a good position for the future, there's a couple things that you should be doing and a couple things that I believe are very, very important to your business, and you should really follow these practices. And the first one is going to be a reserve cash flow. If you look at your business, obviously you have your business checking account, which everybody has, but you should have a savings account for your business as well too. And maybe you even have a high yield savings account that brings back some interest. There's banks out there that are offering 5% on business savings accounts. So if you really look at reserve cash flow, that's the easiest way to do it, is to set aside a savings account. You're getting this profit in weekly, monthly, take a portion of that profit and put it into a savings account for reserve cash flow for future use, and use that as your forecasting tool as well too. When you're talking about open a savings account for your business, I really look at it as running your business no different than you run your personal finances. Everybody has a checking account because you have to pay your bills, but you probably also have a savings account or a money market account, or maybe some investment accounts that you have that you fund money into for your retirement. And your business should be no different. Treat it exactly how you would treat your personal finances. You want some kind of extra account open where you're putting some money in there for a rainy day, if you will. So having a reserve cash flow set aside in a savings account is a great way to ensure the financial stability and the health of your business, and making sure that your business is healthy. God forbid something happens with one of your clients and they file bankruptcy, chapter 11 or chapter 7. If it's a restructuring bankruptcy, you may get something out of it after the restructuring is done, but restructuring takes a year to 2 years. It could take longer depending on the size of the company. And then after it's restructured, there's no guarantee that you're going to get any money out of it anyway. And if you do get some money out of it, I promise you, it's not going to be the full receivable that you have on the books with them. It's going to be pennies on the dollar. They're going to offer you a very, very low settlement. So I would start putting some money away in that cash flow, that savings account, so that you have that in the future. That is a great way. And the first thing I would do once you start getting in profit is to stash some of that profit away for future use. And I don't stash it all away because you're going to need that profit for growth, and also use that for forecasting as well too. But a savings account is a good way to go. A high yield savings account is a good way to go for your business as well. The other thing that I would do, and this is extremely important, and we talked about net 30 from the time you bill out to the time you get paid. Your accounts receivable. I mean, you really got to have your accounting department tight. If it's you running it, or you have an individual running it, or a team running your accounts receivable, accounts payable, I mean, it needs to be tight. Best practice here is to make sure that you are invoicing out the day the work is done. And the reason I say that is because the clock doesn't start on the net 30 until they receive the invoice from you. So if you have, work that was done today and you don't bill it out until next week, you're already 7 days removed from the time the business was done to the time you billed it out. Your clock for net 30 doesn't start until the time that you invoice it out and that you ensure the other side has received the invoice. So having your accounting operation is really tight. Best practice is to bill out immediately when you have the paperwork that you need to invoice your clients. Bill it out immediately. Make sure you're overseeing your accounts receivable, payable department if it's not you, and making sure that's done in a timely fashion, because again, the clock doesn't start until you bill it out. And this is on net 30s that I'm talking about here. There's segments of the industry out there that run on net 60, net 90. I've heard of net 180. Man, really be careful when you're out there dealing with companies that are in that kind of pay terms. We talked about bankruptcy a little bit here, but if you're looking at financial welfare and the health of your business, you can also do it on the other side and take a look at somebody's financial well-being or health of their business through their payment habits. Are they paying on time within the net 30? Are they paying under net 30? Are they paying over net 30? So you get a good gauge on their average pay history, and you can tell kind of how their operation is running and the health of their business. But if you get into these higher net terms, you're not going to know if there's a problem until probably it's too late. I mean, think about it. If you're doing $10,000 a week in business with somebody and they're on a net 180, let's say, God forbid, you could be knee deep into them for $250,000 and you don't find out until day 100 that they have some financial problems. And then, like I said, you're into them for $250,000. I mean, you really put your business at risk. So there's things that you can do with that too. If you come across a company that is on a high pay terms like that, or they want that high net 180, 90, 60, whatever the case may be, anything outside of net 30, I would try to negotiate it down. I would work with their controller or the powers that be on the other side and say, hey, look, we're a net 30 company. We really like to get those payments in on net 30. Maybe you can offer them a discount for paying it inside of net 30. Say, hey, we'll give you a 2% discount, 3% discount, whatever the case may be, to get that money in. Not only does it help your cash flow on your side, but it also gives you an opportunity to take a look at the overall health and welfare of their business as well, too. Sure. Again, great question. When you're looking at what you should set aside, it really comes down to, how much you're bringing in, what your profits look like, what you're forecasting. We talked about that, what your forecast model looks like for the future, for use, whether you did it for 60 days, 90 days out, or maybe you're looking even further. Maybe you're going a year out, 2 years out, looking at the bigger picture. But when you're looking at setting aside money, you first want to take a look at, you got your reports from your CPA, which we've discussed before. Hopefully you're using a CPA, and they're going to give you your net profits, your EBITDA for the company for that month, that year, that quarter. And the EBITDA is just a fancy way of saying that this is your complete profit that your company has generated after everything's been paid, your taxes, your payroll, your IT, all of that stuff that goes into the business, your rent, if you have that. But for setting aside money for future use into a savings account, again, I highly recommend that you find a high yield savings account, whether it's with the same bank you're using for your checking account or even a credit union. Typically, credit unions offer a little bit higher percentage on the yield with savings, so make sure you do your research there. But I would put away at a minimum 10% of your profits on a monthly basis for future use. That's on the low end of it. Look at it again, when we're talking about business, kind of relate it back to your personal finances. What are you putting away on your personal finances monthly into a savings account or to an investment account? Some people are putting away 6%. Some people are putting away 10%. I hear people putting as much away as 19% annually. So, you really look at that and say, how much money do I think I'm going to need in the future? That goes back to your forecasting. But I think 10% is a very, very good start for you. Put 10% aside of whatever your net profit is monthly into a savings account and let that money work for you. For every 10% that you're putting in there monthly, obviously that account grows. So you're putting money in there every month, and on a high yield account, you're getting the percentage on the balance of that account. So every time you add money, that 5% is actually more every single month, because let's say there was $1,000 in there, you were getting 5% on 1,000. The next month you have $5,000 in there. Now you're getting 5% on 5,000, and so on and so forth. So when you get that account up to, 50, 60, 100 grand, and you're making 5% on that annually, you're starting to make good money, and your money's starting to work for you and help you. And that money is going to be used as a later date for growth, for hiring, for new office, new tech, new furniture, whatever the case may be. So I think 10% is a good place to start if you can afford that with your cash flow and with what you're currently doing. Now, I know that's not going to be realistic for some brand new business owners, because again, cash flow and being cash heavy is extremely important in the beginning. But if you've been in business for a while and you got money just sitting in that checking account, you're not making anything off of it. Take some of those profits out of there, put it into a savings account, and let the money work for you. Let it do its thing. Let it grow, and get that percentage back from the bank for holding your cash. The amount that you're going to reinvest, first of all, there's two places that I would be investing in your business that are key to growing your business and to ensuring financial stability and growth and profits. The first one is going to be your human capital. We've talked about that in other podcasts before, where human capital is obviously the people that are working for you. That's where you get the most bang for your buck. That's where you are going to see growth, not only in your profits, but in your business. The more people you have working for you on the sales side, obviously, the more business you're generating, the more profit you're generating. So, human capital is definitely where you need to focus on when you're growing your business. And then the second part is going to be tech. Tech is not overrated. It's expensive. I understand that. But in this day and age, technology is everything. You can't have a slow running TMS, a crappy phone system, a crappy accounting system. You got to make sure your tech is tight. So if you went very bare bones at the beginning with your tech, I would be looking at investing into some upgraded tech. And then I would also be looking at investing some of those profits into the human capital. Those costs are going to vary depending on what you're going to do with it. So, that's why you have that savings account where you're generating profits on the percentage that you put in there. Take some of that in there and reinvest it. The cost is going to fluctuate because you never know what you're going to pay for on the human capital side. You could be paying a high salary with low commission, or you could be paying a high commission with a lower salary. So it's really hard to pinpoint what you need to be reinvesting on in that and how much that's going to cost you, because you don't know what the talent is going to cost you. You might come across somebody that is phenomenal that you really want. They're really interested in your company, and you say, I need to get this person on. I need to get them inside the company. I think they're going to be a rock star here. And you may have to go out and you may have to go over what they're currently making by 10% or 15% just to attract them over to you. And that's okay. That's not a bad thing. Is it more than you wanted to put out? Yeah, sure. I mean, everybody wants to spend as little as possible that they can inside a business because they want to protect their profits for a couple different reasons. But again, human capital is the best investment that you can make. That's where you see all of your returns, is investing in human capital. But don't forget about the tech either, because those people that come in and work for you, they want to be able to work seamlessly, and they want to be able to rely on the technology that you have so that their business is not stifled by technology problems. And on the flip side too, your technology's got to be good so that your customers get the service level that they expect and deserve for you. That's a great question. I've heard so many different stories about this. I've talked to a lot of people in the industry through the course of my years. Everybody has a different idea of what they should be making on a gross profit level as far as percentage wise. With the way the market is right now, it's not, the percentage is not going to be the same as it was in 2021, 2022 era. It's just not. Your percentages were extremely higher. I heard people running somewhere in the range of 18 to 20%. That's extremely, extremely good when you're talking about gross profit. I mean, in those areas, they probably could have taken some initiative and talked to their clients and maybe scaled that back a little bit and got some more business and show them that they're also working for them and not just themselves. But that's just an opinion from a business owner to you guys out there. But when you're looking at benchmarking or saying, hey, what's a good percentage for a new business or a current business, I would be trying to run in the range of a gross profit of right around 10%, because that's going to dwindle down to a net percentage of somewhere around 7 to 8%. If you're running 12%, it'll be a little bit higher, but that's where I would shoot for your gross profit model, is in the 10 to 12% ratio, because the net on that is going to be, anywhere from the 6 to 9%. And that's still very healthy, depending on what you're doing for sales. So I would shoot for that number right there and keep it in that range. I think that's very respectable in this industry right now. And I think it also keeps you very honest to your clients and to your carriers. And it also allows you that profit to put aside as well too.
Mm. And so as far as like paying out carriers go, what are some cash flow management tips that you have for people out there that could allow them to again have efficient cash flow management, so that they're not like in a pinch if they have to pay a little bit more, if they have to maybe take a loss on the load.
Yep.
What are you recommending that in that area?
So that's actually a really good question, and this goes back to your accounts receivable. Honestly, they're tied. They're very much tied together. What you're able to pay out versus what you're bringing in, and so it goes back to your accounts receivable. First of all, when you're talking about paying carriers or paying credit companies or factoring companies or whatever the case may be, technology companies, that's integral part of your business. You're on net 30 with them almost always. There's
Hmm.
some are even less than that. Some are, a net 10, net 7 from the time of invoice. So whatever that net term is that you have, you want to stay right inside of it. As a brand new business, you may want to pay it a little bit early. If you're on a net 30, you may want to pay, at the 24, 25-day mark. If you can swing it, maybe at the 20-day mark, depending on your cash flow. And the reason I say to do that in the beginning is because you want to get your average days to pay. And we talked about that earlier. You want to get your average days to pay on your side to be healthy out there in the credit industry. So if you're on a net 30 and you're paying them in 20 to 25 days, that's how they're going to report it. They're not just reporting, hey, he pays within terms or she pays within terms. They're going to say, hey, the company paid at 24 days. So they're paying ahead of terms, which
Hmm.
will ultimately raise your credit score as a company. So if
Yeah.
you're able to do that, you want to pay them ahead of terms. But otherwise, once you get established, you want to pay right at the terms. And when you're paying right at the terms, hopefully you're set up on some kind of treasury management account for payables with your bank, your business checking, where you can go on and you can do same day ACH or ACH that'll hit the next day. So if it's due in net 30 and the bill's due tomorrow, you run the ACH today. If it doesn't pay out today, it pays out tomorrow. So it hits right on that net 30. You're staying within terms. Now, the way to really maximize your cash flow here, and this is the trick here, is again, we're going back to accounts receivable. Invoice out the day that the work is done. Do not hold on to those invoices. I know a lot of accounting practices out there inside businesses. They'll say, well, we'll get it billed out in the same week or the following week that the work was done. Don't do that. Get it out immediately, because what you're doing is theoretically, if you're on a net 30 and you're paying out in a net 30, if you bill out the day that it was done, the work was done, typically you are not going to see your invoice to pay out for at least a couple days, sometimes a
Hmm.
week, and then sometimes even more, maybe 2 weeks if you're lucky. And what that does is that really boosts your cash flow, because if you're billing out on the same day that the work is done and you don't get the invoice from your vendor for a week to 2 weeks, you're going to have all of that money in from your client for that work that was done before you ever pay it out. So not only do you have, because if it was profitable, not only do you have the money to pay out the carrier, but you also have your profit in. So now you're on the cash flow positive side. So you're using money from the client to pay the payables. So you're not using any of your cash, any of your accrued profits to pay out those vendors. So that's why I really harp on the accounts receivable and the accounting department getting that stuff paid out immediately. Don't wait on it. If it's done that day, really get on them. We need the paperwork, get it in, get it invoiced out that same day, because you're going to be ahead of the curve. You're going to have your profits in, your money in before you ever pay out. That is the single biggest thing that you can do to really boost your cash flow inside a business, is make sure you're paid before you pay out. When we talk about at a basic level, it may be basic, but it is the most important part of your business. I mean,
Hmm.
your cash flow is everything. If you don't have the cash flow that the company has generated to make your payments, then you're dipping into your own personal finances in order to fund your business. And you don't want to do that. Now, you may have to do that at the beginning when you first start your business, but that's part of business. Any business owner knows
Hmm.
that there's going to be some sort of personal capital invested into your
Right.
business to get it up and running. But when your business is up and running, you want to be making payments out to your vendors on the payments received in from your clients. There is nothing more important than that, is to ensuring that you are getting the money in prior to paying out. And that's again why I say your accounting department, you got to oversee it. You got to make sure the health of your business is really top notch. You want that money in You want that profit in, that profit comes in, the money from that work comes in, you take some of the profits, put it aside in the savings account, you're starting to build that up over here. You have the money from that. You've had it for a week, 2 weeks, 3 weeks, and before you even have to pay out, and now you're paying out the vendor on the other side that did the work for you. So again, it may seem on a basic level, but it is the most important part of your business is making sure that you have that money to pay out so that you're not dipping into your own personal finances. And again, you can see the health of the other business that you're doing work for. Are they paying on time? Are they not paying on time? And if they're not paying on time, it's time to have a conversation with their accounting department
Yeah.
and say, hey, what is going on here? We got invoices that are past due, overdue. Your typical pay history is, over terms by 10 days. That's not a good sign. So also when you're doing your invoicing, you want to make sure that they receive the invoice. Just because you sent it out doesn't mean that they received it. Again, we go back to technology. Things happen, things get lost, it goes into their spam, it never reaches them, whatever the case may be, whether you're mailing it or emailing it. If you're mailing it, you definitely want to follow up on it because mail is historically slow now. It could take 7 to 10 business days just to get to them. So you're really setting yourself backwards. Hopefully you're on an email invoicing basis with your clients so that you can send it out the day that you get the work done. You can send them an AR report and say, hey, this is what we've invoiced out for you. Are you missing anything? They'll confirm it and say, yeah, I'm missing some paperwork here, or no, we have everything. And then you really track that weekly and you send them a report. Here's your current receivables to our company over here. Is there anything that you're missing? And you can follow it right down there and make sure that you're getting paid on time. One other thing I will say about accounts receivable, especially if you're extending people high credits in the logistics industry, that's not uncommon that you're extending very high credit limits to companies. You're going to do your due diligence out there and you're going to see that company's financial stability. How long have they been in business? What's their credit rating out there in the industry? You're obviously tracking them on your side with their average days to pay so that you can see how that they're doing as far as health wise with their business over there and paying their bills. But one thing that you can also do, and a lot of people probably don't know it, is there is a thing called AR insurance. There's companies out there that will insure your AR for clients that you do business with. And what that entails really, one, that's a huge safety net for you. Does it cost money? Yes, it costs money, depending on how much you're going to insure on your receivable for that client. It does cost money, and everybody's like, well, insurance is a waste of money. I never use it. Look, you don't need it until you need it. And when you're talking about high credit limits and high receivable amounts, you may want to consider it. If you're extending somebody $100,000 or more in credit, you may want to take a look at some of these companies out there that offer AR insurance. And so basically what that is you call this company and you say, hey, I'm doing business with X, Y, and Z. I want to insure their AR. They're going to say, okay, let's take a look at it. They're going to tell you what the recommended credit limit is for that company, and that's what they're going to insure. So if you're extending them 100,000 and they're saying, hey, we only believe that their credit should be extended to 75,000, we will insure that amount. So you're going to pay a premium to make sure 75,000 is insured in the event that they go bankrupt or whatever the case may be, they don't pay their bills. You can act on that insurance and you're covered on that 75K. And then your exposure is going to be anything over that. So instead of having, if you got $100,000 credit limit and you're insured for 75, your exposure is only 25,000. So that's what you would be on the hook for in the event that they went bankrupt, belly up. You could act on the insurance, get the 75, but you're going to be out to 25.
Yeah.
So if you're doing stuff like that, especially with these companies on these higher net terms, 60, 90, 180, I would very much recommend you take a look at that. It's going to ensure the health and welfare of your business. It's going to protect your cash flow. It's going to protect the savings that you set aside in there, your profits. So take a look at that out there. I think it's extremely important for business owners to know about AR insurance. And I don't think a lot of people know about it or have even heard of it, or maybe they dismiss it, but it's something that you should certainly take a look at. It's worth your time. So a couple of things there to address that is, your profits that you set aside, that's your safety net. That's what's going to allow you to grow. It's going to allow you to be a little bit more comfortable and take a little bit more risk out there. And by taking risk, I mean, you may again, like we just talked about, you may have AR insurance on somebody, but they're giving you a lot of business and the AR won't cover the overflow of whatever it is. So your profits that you set aside will allow you to do that because you have that safety net from the profits that you
Hmm.
set aside and say, hey, I can get a little bit more aggressive with this. Obviously, I'm going to have to take a look at their pay terms and make sure they're staying inside of healthy pay terms, but I can take that risk because I've managed to put away that money. I've
Hmm.
saved some of the profits. So what it does is your profits and putting that away, it allows you to grow more because you have that safety net. You can take bigger risks. You can take risks with extending higher credit limits outside of the AR
Hmm.
insurance. You can take risks by hiring on more human capital. You can take some risks on expanding the size of your office, getting some brand new tech. That's the newest and best thing out there, which changes all the time. So you can use that money as your safety net, and that's being aggressive with the profits that you've put away. It becomes your safety net. So I think that's the biggest thing that you can do with your profits out there. The second thing is to remember this as a business owner, you're the last one to get paid.
Hmm.
Obviously, nobody likes to hear that, but you should be the last one to get paid. Right now, you're trying to ensure the health and welfare of your business, but you also have a duty to ensure that you're able to support the human capital or your team. So they get paid first. The vendors or people you owe money to, they get paid, and you get paid last. So you may want to, or you may have to, take a little bit less on, your salary from your company or the profits if you're taking K1s on, an S corporation where you're taking out some money in profits quarterly. You may have to take less, a lot less, until you get into a position where you're really financially and healthy with your company that you can take more. So you want to look at that. Everybody says, or a lot of business owners out there are like, I'm making this money, I'm taking it all out. Don't do that. All
Hmm.
you're doing is putting your company at risk. You're putting your employees at risk. You're putting your team at risk. You're putting your business at risk. You are the last one to get paid. And, when you're starting a business, typically business owners won't take anything off of the company profits, including payroll, for anywhere from 6 months to a year because you're building up that cash flow and that savings account so that you are financially healthy. And then
Hmm.
maybe going into the second year, you start taking some money back out for yourself. You're paying yourself a salary, you're taking some profits out quarterly on a K1 or whatever the case may be. That's when you start taking money out. But as a business owner, to be aggressive with it, you want to make sure that you're the last one to be paid. Don't be that business owner out there that says, hey, I'm making all this money. After everything was paid, I'm not putting anything in the savings account over here. I made, an extra $10,000 this month. I'm going to go out and buy a new car. Or you can't get a car nowadays for 10,000, but I'm going to go out and buy something else. Don't take all of that money out of there just because it's in profit. That's not ensuring the longevity of your company. It's not. You're hurting the health of your company. You're putting your employees at risk. Your
Hmm.
employees are relying on you. They are depending on you to make sure that your business is healthy in a state where they can continue to work for you and receive a paycheck. They have families too. You made the decision as a individual to go out and start a business. You have a responsibility to your business and to your team members to make sure that they are taken care of. So that is what you do with the profits. You are the last one to get paid. And if you keep that in mind and you use that as your guiding light, if you will, in business, your business is going to be fine. Just remember, it's all about the business and the longevity of the business and the team members that are working for you. Make sure they're getting paid first. They are, and it's not just the brokerages that did it. So they were making, again, these high gross margins, and they were making just a ton of money, and they weren't doing what we're talking about here. They
Yeah.
weren't putting any of that money aside. They were taking all the money out, all the profits, and they were doing grand things like buying excess amounts of trucks, or they were, making, in my opinion, very stupid decisions with
Hmm.
their profits, and they weren't saving any of it for a rainy day. It was not sustainable. It was
Hmm.
never going to be sustainable. It was great while it was happening, but you should have taken the majority of those profits and stashed them aside for what's
Yeah.
exactly happening right now. It's a
Yes.
market downturn.
Yeah.
And then we're also talking about election year. I mean, the economy is just very uncertain. Nobody knows what's
Yeah.
going to happen. So the economy is not good. but you saw a lot of carriers where it happened to too. Brokerages in general as well too. They didn't do anything correctly with their profits, and so they spent the money and God knows where, and they weren't able to maintain a longevity business. And it was the same for carriers. They went out and made all these investments, and then all of a sudden the market turned around and flopped on its back, and they were making, half of what they were making, sometimes in cases less than half. And so now they were strapped with all these bills and they couldn't maintain it. They
Yeah.
couldn't maintain it. So they ended up going belly up. And all that does is hurt the market even further because now you shrink the supply. The demand was still going to be there, but the supply went down. So now it becomes very strained. The market becomes strained because the supply is down and the demand is still there. Will the market turn around? Will it level out? Yes, I'm 100% certain that it will. It's cyclical, it's a
Mhm.
market downturn. It's going to come back. Is it going to come back in the fashion of 2021, 2022? I highly doubt that because, again, it's not sustainable on either side. It may be good for us on this side or you on this side if you've got that kind of business model that you're running right now. But you got to think about it on the other side as the buyers and sellers.
Mhm.
Is it sustainable for them? You saw a lot of companies, fold up shop or declare restructuring and bankruptcy because it wasn't sustainable. And then everybody gets hurt in that. They get hurt, their creditors get hurt, you get hurt as a company because you got this huge receivable out there with them. You're getting pennies on the dollar, if anything. So it's just, you got to be smart about what you're doing here.
Yeah.
This is not an Instagram model. This is not an Instagram business where, you got no overhead. It's just you out there making videos. And you're right. I've seen a lot of this stuff out there. I'm driving a Lamborghini. Don't be that guy. Don't be that girl. Don't be out there buying Lamborghinis with your profits or buying, $50,000 watches. Don't do that. Take
Yeah.
that profit, set it aside, think about the health of your business, think about the welfare of your employees, and make sure you're able to sustain yourself during market downturns, come out on the other side, still in business and still ready to grow. I mean, when you're looking at business, I talk to a lot of, in my business now, I talk to a lot of freight broker companies, freight agents, and, I hear a common theme and it scares me. It really does is, what does your business look like? Let's talk about the health of your business. And when I'm talking to them, I'm trying to get a gauge on one, what does their revenue look like? And then two, where's that revenue coming from? And usually when I get to the second part of that question, oh, we have, one client or we have two clients that are really big. They're doing really good for us. We're doing really well. Well, that's great to hear. But again, is that sustainable? What happens if something changes? I'm not talking about just bankruptcy. I'm not talking about some kind of unforeseen economic downturn or some kind of instability inside of that company. I'm talking about something simple like, the person that you're dealing with on the other side, there's a change in position. There's a change in operation efficiency for them. Maybe they decide that they don't want to do business with you anymore for whatever reason, or maybe they do. They fold up shop and they go restructuring, or they go bankrupt altogether, or they just close down shop, or they get sold to another company, and that company has different ideas about the way that they want to go with how they're operating their business. Do not rely on one or two clients. We've talked about this before in our conversations, and I think I've dived into it in a few newsletters as well too. Diversification is everything. That's great that you got your Moby Dick out there and you've captured him and he's doing well for you and you're getting fat off of it. That's great, but don't rely on that to sustain your business model forever and for the long term because things change. You need to go out there and you need to diversify. When you're building your book of business, you're constantly, pounding the phones, you're marketing, you're sending emails, you're having conversations. Don't forget about that. Don't forget what got you to where you're at right now or where you're going. Just because you landed a whale account doesn't mean that's where it stops. You should always be out there having conversations, always be looking for the next Moby Dick, if you will. But also, I call them fillers. There's nothing wrong with having 30 clients on there that maybe give you one project a week or something like
Mhm.
that. That's actually better for you than relying on one whale account that gives you 40 projects a week
Mhm.
because something could happen inside of there, whether it's pricing or again, they have a problem. So diversification and constantly selling, constantly bringing on new business, constantly building your brand, your company's presence, getting more market share out there for your business. developing and investing in your human capital so that you can do those things. That's the most important thing for your business. That's what's going to drive you into the future. That's what's going to make you sustainable. And that is what's going to ensure the health of your business. And I mean, we got something coming out, Freight Brokerage Mastery. It's going to give you an overview, really dive deep into the course of freight brokerage. It's going to help you understand the business, the ins and outs of it, the common pitfalls that we don't want to see you make.
Yeah.
We got that out there. Obviously, the consulting side of the business. You know, you can email me with your questions. You can set up a time to talk to me directly. Keep that in mind when you're looking at the company. You're going to be talking to me directly. I want to make sure you guys succeed. If you are going out and thinking about starting your own business, let's have a conversation before you do that. Let's make sure that you understand everything from start to finish and everything that's going to entail starting your own business, what you're going to need. Let's make sure that you get off on the right foot, and let's make sure that you're sustainable and that you're successful. That's what we're doing here, and that's why we started this company. I want to hear from you. So if you have questions, email me, reply on some of the podcasts if you want to leave a comment. But reach out to me. I'm happy to talk to you guys. I want to make sure you succeed out there. Yep. And remember, this is a marathon, not a sprint. Train accordingly.
Yes, sir. All right. Let's wrap it up.
Cool.
Cool. This is besides that. So